I want to ask you now in a lightning round. You can answer as short or as fast as you want. Some questions from all over the map. So, first, I want to ask when we see a dollar shortage, which country do you think is going to be most affected?
Well, right now, I think if the energy shock continues to be the primary source of it, it's going to be in Asia. Somebody in Asia, it could be the Philippines, because Philippines are really desperate for fuel, and therefore the two sides of it, both supply as well as demand. But I think the real downside case there, as I said before, is 97, 98, for various very different reasons than 97, 98. 97, 98 was all about real estate bubble and credit expansion. Now we're talking about something different, but it's similar type of circumstances. I think Asia under the energy shock scenario.
Next one for you. How important is the election of Kevin Warsh to the Fed? Is it overhyped or underhyped?
No, it's completely irrelevant. To me, it's totally irrelevant.
Okay, next one for you. What about the Japanese yen, its strength compared to the dollar? Is this something people should be focusing on, or is it also irrelevant or maybe unimportant?
The way you look at the yen is when the yen is falling, the yen falling is usually a negative signal on global economic prospects, because that's the Eurodollar system demanding a higher premium out of the Japanese. When the yen gets stronger, not necessarily a little bit at a time, a gentle rebound in the yen's exchange value, but when the yen spikes, that's a bad signal, because what that says is the Japanese carry traders are reversing, which would be because of some negative phenomena that's taking place. You saw it in August of 2024. Japanese reacted to what actually ended up happening, which is job losses in the United States and the recession prospects that go up with it. The Japanese carry traders in August 2024 were basically warning us about the private credit bust. That's what they were saying, because the Japanese were the primary investors, not the private. They were one of the biggest sources of funds for the private credit bubble. So what they said was, hey, U.S. economy is taking a step for the worse. We're in some of the riskiest corporate credit that everybody's now talking about in 2026. They started to pull back. And when they pulled back, that's when the yen spiked, and it led to all sorts of disruption around the world. So the yen if it goes down, that's not a good sign for just broader economics reasons. If the yen spikes, that's the carry trade reversing, which is more financially focused.
Now I want to talk about these BRICS countries. Obviously, in the past, people have said, oh, there will be this BRICS alliance of countries. Do you think that this BRICS alliance, this whole idea, is now basically dead after this war or this conflict in Iran? Or do you think that, no, there's actually something here to this BRICS alliance going forward because of a deglobalized or a fracturing global order?
Well, to me, the BRICS alliance is more political than it is anything else. There will never be a BRICS currency or a BRICS currency block or even a BRICS trading block. As much as, for example, India and China, which are basically the center of both, as much as they've made nice recently, to me, they're still more likely to be at war than they are to create some kind of common framework that's something so important and substantial as monetary or even just bilateral trade. So you're never going to have a true BRICS block. Instead, what it is I think this is what's going to last for a long time, is the BRICS is a political framework for the quote unquote global South to have a venue to challenge the G7 or the G20. In other words, it's, hey, we're down here and we got the vast majority of the population on the planet. We're impoverished. We need some kind of framework to be able to get attention and say, to maybe wield some political power if we possibly can, if we ever get some. It's more of a political animal than it is financial or monetary.
What about silver? So we've talked about gold today being this kind of safe haven asset where people are running to when they say, I'm just not so sure about the modern economy. But obviously silver in the past has been used as a smaller denomination payment. But in a world with tokenized gold, how important do you think silver is going to be going forward as a monetary medium as opposed to an industrial or commodity metal?
Well, there'll always be that natural tension, especially since, unlike, the 19th century when silver was basically the primary monetary metal, at least for hand-to-hand commercial transactions among regular people, low value transactions, there wasn't the same industrial usage, which means that, silver could be just an alternative precious metal, where nowadays, I think that natural tension actually creates problems to using silver more broadly as a strictly monetary format, because there's always going to be demand from the industrial side. And I don't think that's going to lessen. I think it's only going to increase. So I think over time, silver kind of disappears more and more from the monetary landscape. Not entirely, but I think it becomes more purely an industrial metal rather than a precious metal.
And what about other metals? Obviously, there's other commodities like platinum, palladium. How important do you think those are going to be going forward, especially with things like tokenization? Do you think that we're going to basically stick to gold as the main money metal and that these other metals will just begin to be commodities but maybe tokenized? Or do you think, hey, now with these new technologies, there's a chance that these metals get a second look?
I think they get token. I think everything gets tokenized eventually, but it's not that we're going to have copper tokens, a copper backed currency. It's more like, hey, we've got some physical copper that's represented on the blockchain by a token. Therefore, it can be used as collateral to borrow some gold backed money. Right. I think that's where it really comes into it. Commodities are, because of their industrial usages and the fact that they're really cumbersome to try to use in any other kind of format. It's useful as a short run collateral in case, you're arranging some kind of financing for the metal, but it's not necessarily useful as a backing for a medium of exchange. That's a robust medium of exchange that does more than just limited use cases.
What do you think about the Fed funds rate? Do you think we're going to be in a world where it remains elevated? Are we going back to a zero interest rate policy or ZIRP? What is the status of the Fed's funds rates going forward? Is it going to be volatile? Are we stuck in a certain pattern? What do you think, Jeff?
Well, all the markets have been saying really consistently since 2021 is that rates eventually go back down to zero, low rates, whatever. I mean, not necessarily zero, but they go back down. Whether it be the swap market, just the yield curve, for example. The yield curve, when it inverted in March of 2022, what was that saying? However high rates going to get in the short run, they're going to eventually go lower in the longer term, which we've kind of gotten that way. You look at where the 2-year was. The 2-year treasury went all the way up to 5%, and it's down a point in 140 basis points in there. It's still got a long ways to go. Again, simple yield curve mechanics, where the 10-year treasury is today and where it wants to stay around 4%. A normal yield curve is it's really 250, 300 basis points steep. It was just using 200 as a sort of back of the envelope guideline. If the 10-year treasury goes no further lower than where it is today at, 440, 430, that implies a short-term rate somewhere around 220, 230. So even the yield curve itself is saying rates have a long way to go lower. And then you go beyond that. You look, interest rate swaps is a big one. Interest rate swaps have been saying, as I said, throughout, especially over the last couple of years, that short-term rates, because they're tied to SOFR, short-term SOFR rates are going to go down. They're going to go down a lot, and they're going to stay there a very long time. And so the interest rate swap market, and by the way, it's the most important market in the world. It's even more important than treasuries. When the swap market says short-term rates are going to go down in the future and stay there for a long time, you need to say, okay, how the hell can that possibly happen? And in the years since 2022, when that really started, you can see how that can happen, because as we go further along, what we've been talking about, more and more, we're talking about an economy that's generating unemployment. We've got private credit bubbles. We've got all sorts of problems, an energy shock. Now, everything that has thrown up and happened along the way is further proof or further establishing the path toward rates that end up going a lot lower. We don't know how they go there, what ultimately causes rates to go down. But right now, there is no shortage of possibilities that lead to that, lead in that direction.
What about this idea of, hey, the yield curve always predicts a recession, it's this great recession indicator, and yet now we're seeing that actually recession indications are actually at their lowest that they've ever been in terms of prediction markets, for example, betting that there won't be a recession. What is the correlation, the relationship between the yield curve as a recession indicator? Do you think it's broken? Do you think it's misunderstood? What is that correlation?
It's misunderstood because we have to define what we mean by recession. Most people define a recession as when the NBER gets together, usually a year after recession ends, and says, hey, guess what? There was a recession a year ago. So people think that a recession looks like what the NBER says it looks like. What the yield curve said, and all the yield curve ever says when it inverts, is that rates are going to go lower in the future. That's all it says. When the yield curve inverts, that it tends to correspond with what people call a recession, which is a contraction in the real economy. So the yield curve, when it inverted in 2022, said rates are going to go lower in the future. It doesn't say why, it just says that they're going to. Now, I think we've been in a recession since 2022, because when you look at, for example, the labor statistics, we've lost jobs. Just look at the trend in the establishment survey, nothing more than that. The establishment survey was going like this, and then it just stopped growing, and now it's sideways to lower. And that started in 2023. So the yield curve inverted in 2022, which said something bad's going to happen. Doesn't need to be catastrophic. It doesn't need to be 2009. But the economy, the markets, they're going to be more volatile. The economy's not going to function. And that's what we see. The labor market stopped growing at the very least. And now it has started to contract ever since really late 2024. The Japanese nailed that one. Since 2024, we started to see job losses accumulate. Now, people can come up with all sorts of explanations why that is, but it's consistent with the yield curve warning Something is going to happen. Accumulation of events are going to happen that are going to lead to interest rates going lower. So the yield curve didn't get it wrong on recession. It's people's definitions of recession that don't fit what the yield curve was describing in 2022. We don't care. The market doesn't care about the NBER. The market cares about the circumstances in the real economy. The portfolio that performs in one economic regime can get crushed in the next. So in this free webinar, we're going to reveal what those 4 economic regimes are, how to identify them, as well as the assets, historically speaking, best positioned to perform in every environment. So reserve your seat now and learn how to prepare your portfolio before the economy shifts again.